What we are going to learn today is risk analysis in capital budgeting or capital expenditure decisions. Try to understand why this chapter. For a company, there are two projects available, Project A and Project B. For a same company, say XYZ Limited. What are number of years in Project A is 5 years, number of years in Project B is 5 years. Their discount rate, required rate of return of Project A is 10%. So that discount rate even is 10%. Because their cost of capital is 10%, they want that minimum they should be getting 10% rate of return on their investment. Understand, NPV of this project is plus 2000 crores. NPV of this project is plus 2000 crores. And company can take only one of the projects. So either they can take Project A or they can take Project B. Number of years are also same. So equalized annual NPV concept will not come over here. Understand, company may take up any project, but what company is ignoring is this. Return is all right. They are earning more than 10% in Project A also. They are earning more than 10% in Project B also. Their NPV is the same. So company may select either of the project. But what they are ignoring is, what is risk in Project A? And what is risk in Project B? They should minimize this risk. See, what was our first answer? They may select any project and they select, say, Project A. And they did some calculation and found out that risk in Project B is a 50 and risk in Project A is a 60. Any measurement, but they found out that risk in Project A is higher than risk in Project B. Then they have taken wrong decision. They should go for Project B. So whenever you are taking capital budgeting decision, you should always incorporate risk into capital budgeting decisions. Why? What is our objective? It is to maximize return. Agreed. But parallelly, it is also to minimize risk. So you should not take the decision just by considering return. You should take decision also by incorporating risk into capital budgeting decisions. We have done n numbers of methods in capital budgeting decisions. Now we will try that we incorporate that risk factor into capital budgeting decision. Hence the chapter risk analysis in capital budgeting. Try to understand how we can incorporate risk into capital budgeting decisions. Try to concentrate. Either we can incorporate risk into cash flow. How we take capital budgeting decision? Present value of cash inflow. I'm taking the basic method. Present value of cash inflow minus present value of cash outflow is NPV. So we are having cash flows. We will be having discount rate. And we can incorporate risk in number one. Cash flows. We may find out probability, we may find out certainty, equivalent, anything. But we will incorporate or we will take into consideration that risk factor in some or other way in my cash flows. How try to understand? Suppose in this situation, which project was more risky? This. Then we might have reduced cash flow. And so our NPV would have decreased, say by 100 rupees. So this is 1900 NPV. What is this? 2000 NPV. You will always select project B because it is having NPV of 2000. Now you will say, sir, still we have found out NPV only, but we have incorporated risk in cash flows. So we can incorporate risk in cash flow, or number 2, we can incorporate risk in discount rate. So understand, in this case, if project A was discounted by 10%, project B is less risky. So project B was discounted by 10%, and say project A was discounted by 12%. Then believe me, as you increase the required rate of return, you are including risk premium in the discount rate, your NPV would decrease. Say it would become 1800. Which project you will select? 1800 NPV, 2000 NPV, 2000 NPV, other things remaining same. You have taken a right decision. Yes, both the same type of project. B is having lesser risk. Return both are same. Risk in project B is less, and hence the risk is incorporated in this case, not in cash flows. Cash flows will be same in both the projects. We have incorporated risk in discount rate. See the discount rate of A, it is having higher risk, so our required rate of return in that is higher, and we require 12% rate of return. In project B, the risk is lower, we require 10% rate of return. We have incorporated risk in discount rate. Or we may find out a risk separately. So what we'll do? We'll keep everything same. But by some measurement of risk, degree of operating leverage, financial leverage, beta, or by any other methods, we can find out risk separately and then decide which project is more risky, which project is less risky, and we can take decision based upon even a risk factor. So risk can be incorporated in capital budgeting decision in 3 ways. Either you incorporate in cash flow, or you incorporate in discount rate, or you find out the risk separately and then consider risk and take capital budgeting decision is nothing but risk and uncertainty analysis in capital budgeting. What are the methods by which we can incorporate risk in capital budgeting? Methods are even divided into 3 parts. One are statistical method, traditional or conventional method, and other methods. And we are going to today learn all the methods. Statistical methods are: number 1, probability method, number 2, standard deviation. You might have learned it in your foundation in the chapter of statistics, all this, because they are statistic method. Number 3 is coefficient of variation. Those all are which method? Statistical method. What are traditional method? Risk adjusted discount rate, Number 2 is a certainty equivalent method. Others, sensitivity analysis, number 2 will be scenario analysis. These are various methods whereby we can incorporate risk into our capital budgeting decisions. We will be learning one by one all the methods. Let us start with probability method of incorporating risk into capital budgeting decisions. Let us take our Excel sheet and go to probability method. Understand, here the project will be running for 3 years. In first year, my cash flow may be 20,000, 30,000 or 40,000. What is the probability that my cash flow will be 20,000? Is 30%. What is the probability that my cash flow will be 30,000? Is 40%. What is the probability that my cash flow will be 40,000? Is 50%. Then, so this is incorrect. This should be 10%. Because a total probability should always be 100%. Total probability should be 1. This is nothing but expected cash flow. How I have found out expected cash flow? Now this is the concept of statistics. Expected value is nothing but value multiplied by probability. So I have done 20,000 into 10%. I got answer of 2,000. I did 30,000 into 40%, 12,000, and 40,000 into 50%, 20,000. So what is expected cash flow of year 1? Expected cash flows of year 1 is 34,000. I will not take 20,000 as a cash flow. I will not take 30,000 as a cash flow. I will not take 40,000 as a cash flow. But I will find out a probability and take a cash flow of first year as 34,000. Sir, how I have done? I have done it by weighted average, whereby my weight is nothing but probability. This is how I will find out answer of year 2, 10,000, 20,000, 30,000. Probability is 20, 70, 10. Total should be 100. 70 plus 20 plus 10 is 100. Again, I have found out expected cash flow, which is 19,000. Third year, 20,000, 10,000, 4,000, 80, 10, 10. My expected cash flow is 17,400. So, in year 1, the cash flow might be 20, 30, 40. I have taken 34,000. That is expected value by considering probability. In second year, my cash flow could be 10,000 or 20,000 or 30,000. What is conservatism approach? To take 10,000. What is aggressive approach? To take 30,000. But what is the probability approach? I will be taking weighted average. This is average, right? How to find out average when probability is involved? X bar. Sigma x upon n when probability is not involved. Sigma xi pi when the probability is involved. That is x into p. That is 20,000 into 0.10. This is probability. You will be finding out expected value of all 3 years. And now the question is the same of capital budgeting. If my cash flow for first year is 34,000, my cash flow for second year is 19,000, my cash flow for third year is 17,400, and my discount rate is 10%. My cost of capital is 10%. I want 10% required rate of return. Then my present value of cash inflow. You will have to do it manually in examination. It is 34,000 into 1 divided by 1.10 raised to 1. 19,000 into 1 divided by 1.10 raised to 2. And 17,400 into 1 divided by 1.10 raised to 3. What is present value of cash inflow? 59,684. minus present value of cash outflow. What is it? 60,000. What is my NPV? 316 negative. Will I accept this project? No, I will not undertake this project because NPV is negative. Sir, I have taken capital budgeting decisions. The answer is yes. I am absolutely certain we have taken capital budgeting decisions. We are taking capital budgeting decisions. My question is, where we have incorporated risk in this method? We have not considered any risk in this method. Can any student answer me where we have incorporated risk in this method? You can incorporate risk either in cash flow or in discount rate or find out separately. Where you have incorporated risk? Anyone? You have incorporated risk in cash flow. See, I am not taking 30,000 over here or 40,000 over here. What I am taking? 34,000. Why 34,000? I have considered probability. Probability will find out average cash flow and not expected maximum cash flow. So I have incorporated risk in cash flow. You are correct. We have incorporated risk in cash flows. And they are very simple. For every year multiplied by probability, you will be getting expected value of year 1, year 2, year 3, year 4, year 5. How many number of years are there? Just find out present value of cash inflow minus present value of cash outflow. So the same thing we are doing, and you will be getting answer. Instead of cash flows, we take cash flows which are expected based upon probability. And so this method is termed as probability method. Sir, who will give us this probability? Now this is the work of forecaster, economist, chartered accountant, who are forecasting what will be your cash flow, and they will be telling you probability, that probability of 20,000 cash flow is 10%, 30,000 is 40%, and 40,000 is having maximum probability, which is 50%. This was probability method. Let us go to second one, that is the standard deviation. Standard deviation is one of the topic in foundation statistics, but still I am assuming you are not knowing this concept. Understand, there are two projects, project A and project B. Both will last only for 1 year. Both will last only for 1 year. It is expected the project A will be earning 40% rate of return, good rate of return. Project B will be earning 50% rate of return. Sorry, project A will be earning 50% rate of return, or project A will be earning 60% rate of return. What are these options? Project A is such that either it will be earning 40% rate of return, either it will be earning 50% rate of return, or it will be earning 60% rate of return. And the chances of getting 40% rate of return, 50% rate of return, and 60% rate of return is equal. So you can find out simple average. See, what is average rate of return? Is 40 plus 50 plus 60 divided by 3, which will be 50%. So average rate of return for project A is 50%. Let us go to project B. The rate of return expected from project B is 20%, 50%, and 80%. And the chance of project B having 20% rate of return or 50% rate of return or 80% rate of return are equal. So you can find out always average by simple method. If there are weights, you need to find out a weighted average. If there is probability, you need to find out expected value. Expected value is nothing but weighted average, where weight is taken as probability. Average rate of return will be 20 plus 50 plus 80 divided by 3, which is nothing but 50%. So expected average rate of return in project A as well as a project B is nothing but same. My question is, which project is more risky? What is my question? Which project is more risky? I don't want any calculations. I want you to just see the figures and tell me which project is more risky. Anyone? Yes, anyone? Which project is more risky? What do you think? Alright, let me make it more risky so that you will get an idea. This is minus 10% and this is 110%. Still the answer will remain 50%. Huh? Minus 10 plus 50 plus 110% divided by 3 is nothing but 50%. Yes, now anyone, which project is more risky? Average rate of return in both projects are same. No one? Yes, project B is more risky. Why project B is more risky? Because there are chances that you will be incurring losses. See, there are chances you will be having more losses. Sir, but there are chances you will be earning more return. Please understand, if you undertake a risky project, there are always a chances that you will be earning more rate of return. See, gambling, it is high risk, but your expected rate of return and sometimes even your actual rate of return is immensely higher. So if you are taking more risk, there will be more return. But the average rate of return under both cases are same. But as rightly said, this project is more risky. This project is less risky. Sir, here the figures were very simple. 50%, 50%. One was having deviation, another was also having a big deviation, and so we decided that project B is more risky. Can we measure it perfectly? The answer is yes. The best measure of deviation, try to understand. The best measure for deviation is standard deviation. How to find it? I am finding it out for A. 40, 50, 60. Take it as X. Find out average. X bar is 50. We have already found out. Then find out deviation from mean. X minus X bar. What is X minus X bar? How much is the deviation from mean? Mean is average. 40 minus 50 is equal to minus 10. 50 minus 50 is 0 and 60 minus 50 will be plus 10. So what I have done? I have taken one of the average and I have found out the distance from mean. Distance on lower side is also 10 kilometers, say, and higher side is also 10 kilometers. So see, deviation from mean is minus 10 and plus 10. But we are here not to find out a negative or positive deviation. So we remove negative and positive deviation by doing square. Once you do square of any number, it will always become positive because minus minus is plus. This will also become 100. This will also become 100. So what is x sigma x minus x bar whole square is 200. All right. Please understand. But 200 is having two deviation. Number one deviation, number two deviation. So I will do this. 200 divided by 2 deviation is 100. And remember, once I have done square, so I will do under root of 100 and answer of standard deviation will be 10. Answer of standard deviation is, it is also represented by this. Standard deviation of project A is 10. And we can easily see also. See, what is deviate? This is your mean, right? 50% is your mean. How much this is far, how much deviation is there between first and mean is minus 10 or 10. How much deviation, how much is distance between 50 and 60? 10. So standard deviation is coming 10. If you will find out standard deviation of project B, it will be 60 or 60%. Here you can write down percentage. Higher the deviation, higher is your risk, and standard deviation is one of the measurement of risk. Higher the deviation, higher is the risk. So higher the standard deviation, higher is the risk. I'll tell you a simple example and you will get this particular chart. If I am investing in fixed deposit, if I am doing gambling, in fixed deposit, I might be earning 8% rate of return, 8% rate of return, 8% rate of return. See, what are my deviations? 0. There are no deviation. It is fixed that I will be getting 8% rate of return. If I do gambling, my rate of return might be minus 100%, it might be 0%, or it might be plus 100%. Nothing is fixed. It is deviated. Huge deviation. There is more deviation, and so there is higher risk. Gambling is always higher risky than investing money in fixed deposit. So higher the deviation, higher is the risk. And which is the best measurement for deviation is standard deviation. We are going back into our foundation statistics chapter, whereby we will be learning how to find out a standard deviation. If probability is not there, standard deviation of x can be found out by sigma x minus x bar whole square upon n. Under. If you don't do under root, the answer will be of variation. If you do under root, the answer will be of standard deviation. If probability is available, how I find out standard deviation of x is sigma x minus x bar whole square into p. Again, under root. Here, there are other formulas also which are available. Standard deviation of x, it is sigma x square upon n minus x bar whole square. These are also the formulas for standard deviation. You can just refer to the chapter of standard deviation in statistics in probability, and you can find out n numbers of formulas. But in intermediate, normally the answer will be sufficiently found out by these two methods. Either there will be majority of times there will be probability. If probability is not there, we can take simple average and find out this answer. Sir, why there is nothing in this denominator? Because total probability is always 1. So there is no meaning in dividing anything by 1. We will be taking this idea of probability, find out answer and decide which project is more risky. Try to concentrate. There are two projects, say project A and project B. This is project A. This is sorry. There are two projects, project A and project B. Project A will last for 1 year. Project B will even last for 1 year. If project A is undertaken, there are chances that in first year you might be earning a cash flow of 20,000, 30,000 or 40,000. What is the probability that 20,000 will occur is 40%. What is the probability that 30,000 will occur is 30%, and what is the probability that 40,000 will occur is 30%. Total probability should always be 1. If you want to find out X bar, if probability is available, it is sigma xi pi. So I need to multiply these two columns, 20,000 into 40% 8, 30,000 into 30% 9, and 40,000 into 30% is 12,000. X bar will be nothing but 29,000. So I have got this as X bar. Probability is there. So which formula I'll be using for probability? It is standard deviation is sigma x minus x bar whole square into p under root. So first let me find out x minus x bar. I will need the column x minus x bar, and this is nothing but column of x minus x bar. X minus x bar is not important for us. We need to do square of this. So we have done x minus x bar whole square of this. See, in whole square everything will become positive, nothing will remain negative. Now what I want, sigma x minus x bar whole square into p. So I have multiplied p over here. So this is x minus x bar whole square into p. This is the sigma x minus x bar whole square into p. It is 6 crore 90 lakhs. Divide, we need to do under root of this. What is under root of 6 crore 90 lakhs is 8306.62. Standard deviation of project A is 8306.62. Now let us go to project B. Project B is having a similar type of cash flow, just that probability is different. First year it is 30%, second year it is 30%, and fourth year it is 40%. Cash flows are same, just the probability is different. Same way I have found out average, which is 31,000. XIPI 20,000 into 30%, 30,000 into 30%, 40,000 into 40%. Total expected value is 31,000. So X bar is 31,000. How to find out? In project B also there are probabilities available. I will be finding out by same formula, sigma x minus x bar whole square into p. First I will do x minus x bar. Then this is x minus x bar whole square. This is x minus x bar whole square into p. What is the answer? 69. Let me even change one of the, yes, I have changed somewhat cash flow also. So in third situation is 45,000. What is X bar is 31,000, 33,000. This is X minus X bar whole square, X minus X bar whole square into P. My standard deviation is 10,535.65. 10,535.65. Which project is more risky? I am not talking about return. X bar in both the case were different. My only question is which project is more risky? Project B is more risky. What is the reason? Project B is having higher standard deviation. I have found out standard deviation of project A, I have found out standard deviation of project B, and I will be getting higher standard deviation in project B. So project B is more risky. If at all probability is not given, which is very rare, you can easily find out the answer. How? See over here. In year 1, the cash flow might be 20,000, 30,000, 40,000. Now we are not having probability, so we can take probability as equal, or we can just take simple average. That is 20 plus 30 plus 40 divided by 3, which will be 30,000. What is average? 30,000. Which formula we will use to find out standard deviation? It is sigma x minus x bar whole square upon n. This is x minus x bar. This is x minus x bar whole square. This is x minus x bar whole square upon n. And I have done under root. What is coming? 8164.9. So if probability is not there, you can take probability equal, find out the answer, you will be getting same answer. We can find out the standard deviation of every project and measure the risk. This is a method of standard deviation. Can anyone tell me, in the method of standard deviation, where risk is incorporated? It is incorporated in cash flow, it is incorporated in discount rate, or risk is found out separately? Anyone? Fast. Risk is incorporated in cash flow, risk is incorporated in discount rate, or we are finding out risk separately? We are finding out risk separately. Why? Project remains as it is. We are not even finding out NPV. In previous questions, we have not even found out NPV. So forget about cash flows and discount rate. We are just measuring risk separately. That is nothing but concept of our second method, which is standard deviation. Let us go to third one, that is coefficient of variation. Third method, coefficient of variation. Try to understand, standard deviation is an absolute measurement. When we are finding out the standard deviation of project A, we consider only deviation. When we find out standard deviation of project B, we consider only deviation of B, nothing else. So it is an absolute measurement. Always it is good to find out the relative measurement. Like, try to concentrate project A and project B. Standard deviation of project A is 10,000 rupees and standard deviation of project B is 12,000 rupees. But understand, X bar or A bar, the average return of cash flow or average cash flow in project A is 5,000 rupees. Average cash flow in project B is 7,000 rupees. Then project A is less risky, project B is higher risky. Second method, that was standard deviation. But project B being more risky is earning average 7,000. And project A being less risky is earning on an average of 5,000 rupees. Then, what is coefficient of deviation in project A? How to find out coefficient of variation? Try to concentrate. I take standard deviation divided by X bar. That is standard deviation upon. What is standard deviation? 10,000. What is average rate of return or average cash flow? 5,000. What will be coefficient of variation 2? This will be coefficient of deviation of B will be 12,000 divided by 7,000. 1.71. See, what does this mean? Once again, for every 1 rupees of cash flow, for every average 1 rupees of cash flow, you are taking 2 risks. 10,000 standard deviation, 5,000 rupees cash flow. So for every 1 rupees of cash flow, you are taking 2 risks. Here, for every rupee of cash flow, that is every 1 rupee of cash flow, you are taking 1.71 risk. Which is lower? This is lower. Per rupee of cash flow, the risk is 1.71. Per rupee of cash flow, the risk is 2. Initially, we thought this is higher risky. But comparatively to both the projects, see, one project is having a higher rate of return, another project is having lower rate of return. One project B is having higher cash flow, A is having lower cash flow. Then, in this case, you should find out the risk per rupee. Here, risk per rupee is 1.71, here it is 2. How we can find out? By a relative measurement, which is coefficient of variation, which is nothing but standard deviation divided by average cash flow. So this is coefficient of variation. Again, where the risk is adjusted, if you measure risk in this manner, risk is found out separately. We don't incorporate it anywhere. We are finding out a risk separately. We are coming to an end with a statistical method, and I am writing it down in this chapter where we are incorporating risk. We are incorporating risk in cash flows. Here we are finding out separately. Here also we are finding out separately. So red color is where risk is incorporated. Let us go to some traditional or conventional method, and first one is a risk adjusted discount rate. I am taking one example and we will be learning the question. There is a project A which will run for 3 years. In first year, it is expected to sell 1,000 unit, in second year 2,000, and in third year 3,000 rupees units. Selling price per unit every year is 20 rupees. So this is your total sales. Variable cost per unit or per rupees of sales is 40%. Total variable cost, fixed cost is 1,000 rupees every year. Depreciation is given. Profits can be easily found out by total sales minus variable cost minus fixed cost minus depreciation. Taxes are at the rate of 40%. I got EAT and cash flows are nothing but EAT plus depreciation. The chart we have taken in capital budgeting. So now you should be very comfortable with this one. Try to understand, our cost of capital of the company is 10%. Cost of capital of the company is 10%. The point is, at 10% required rate of return, my NPV is coming to 172. But if I just find out NPV, I will not be getting risk incorporated in my capital budgeting decisions. So what I do is, I will increase the risk premium, but in discount rate. What is my cost to borrow money is 10%, agreed. Cost to borrow money is 10%, but I want 10% plus my risk premium. It should be very easy because you have learned capital asset pricing model. You always require your risk-free rate of return plus some risk premium. So instead of discounting at 10%, I discount at 12%. I will discount it at 12%. How much risk premium I want? 2%. More risky project, how much risk premium I want? 8%. A very risky project, how much risk premium I want? 20%. It is dependent how much risk premium you want. But instead of discount rate of 10%, I will use a discount rate of 12%. See, my NPV from 2100 has become 763. I will adjust risk. I will adjust risk in my discount rate. That is nothing but my required rate of return or discount rate will be cost plus some risk. And I will do the same sum of NPV. Just my discount rate instead of 10% will become 12% because I want the project is risky and I am charging 2% as a risk premium. My point is again the same. Where I am adjusting the risk in cash flow or in discount rate, or I am measuring risk separately, where I am adjusting the risk in the capital budgeting decision. Anyone? Now it should be fast. I am adjusting risk in my discount rate. So I will modify over here risk adjusted discount rate. Where the risk is adjusted, it is adjusted in discount rate. So are you considering risk in capital budgeting decisions? If you adjust your discount rate, the answer is yes. So we are incorporating risk in capital budgeting decision. All right. Next is certainty equivalent method. Very easy. We can go somewhat fast. Try to understand, there is one project which will run for 9 years. The project name is Project Alpha. What is the duration of the project? 9 years. The cash flow is expected to be 20,000 in first year, 30,000 in second year, 40,000 in third year, 10,000 in fourth year, 20, 30, 20, 10 and 4,000 respectively in all 9 years. What we do in NPV, we find out present value of this cash flow at our discount rate. We do present value of cash inflow minus present value of cash outflow. We get answer of NPV and we take the decision. Please understand what is done in certainty equivalent. We hire a statistician and tell him that, okay, The cash flow expected in first year is 20,000. Give me what is the probability, what is the certainty that the cash flow will be 20,000. He says the certainty is 90%. So thus, there are still 10% chances that this cash flow will not happen. What is the certainty equivalent? You need to hire an economist who will give you this answer. What is the certainty equivalent? Say 0.9. Then, instead of taking cash flow as a 20,000, I will take cash flow at 18,000. Now you will say, sir, where we will find out certainty equivalent? It should be given in your question, otherwise you cannot solve it. You cannot forecast the certainty equivalent. Here we are having certainty equivalent for all 9 years. And cash flow of all 9 years. What we will do? Cash flow multiplied by certainty equivalent, we will be getting cash flows. We will be taking only our cost of capital. Now we will not be adjusting risk and discount rate. We have adjusted, see, instead of 20, we are taking 18. Instead of this 20, we are taking 16. Instead of 4,000, we are taking 3,800. We have adjusted risk in the figures. What is our discount rate? 10%. What is the present value of cash inflow? 1,09,630. What is present value of cash outflow? Is 1 lakh. My NPV is 9360. I should accept the project. Capital budgeting decisions. Have I incorporated risk in my capital budgeting decision? The answer is yes. Sir, let me prove this. Try to concentrate. If my present value of cash outflow is say 1,09,000, what is my NPV? 360. So if my project is costing 1,09,000 rupees, and if we consider risk by certainty equivalent method, what is NPV is positive, which is positive 360. So we should accept the project. So let me take a cost as 1,10,000. So I need to convert this as 1,10,000. And so what is my NPV? NPV is negative if risk is incorporated. In certainty equivalent, NPV is negative 640 and we will reject the project. Had we not used this approach, certainty equivalent approach, try to concentrate. Can I find out my NPV? The answer is yes. How? I will be taking this cash flow. So I have not taken certainty equivalent into consideration. What I have done? I have taken present value of this cash flow instead of this cash flow. So I have not considered certainty equivalent. So if risk is not considered, what is my NPV? Positive 15,835. I would have accepted the project because I am ignoring risk. Are you getting it? I have incorporated risk in capital budgeting decision. So my answer is coming after considering risk, which is negative NPV and not accepting the project. Had I not taken into consideration this portion, then my NPV would have been positive 15,835 and I would have accepted the project because I am not considering risk in my capital budgeting decision. Let me go to another method. Certainty equivalent. Let us go to certainty equivalent. How we did it? Certainty equivalent method. It is just cash flows. Instead of taking cash flows, we take adjusted cash flows by multiplying cash flow with the certainty equivalent, which may be 0.90, 0.80 and 0.90 again. So instead of taking 100, we'll be taking 90. Instead of taking 200, we'll be taking 160. Instead of taking 300, we'll be taking 270. And then find out present value of cash inflow minus present value of cash outflow. I will still get answer of NPV. I am taking capital budgeting decision. By incorporating risk in, tell me Vinny, where I am incorporating risk in certainty equivalent method, you are adjusting it in cash flow. Risk taken by capital budgeting decisions taken by NPV method, the risk is adjusted in cash flow, and then we find out the answer of capital budgeting. Let us go to other methods. First, let us take scenario analysis. I will be taking example of scenario analysis. Try to concentrate. Understand, a company is planning to take a project which is project A. The project is going to run for 3 period. The discount rate is 10% and cost of project is 8,000. In worst scenario, so I will again hire an economist, tell him that what will be my cash flow in worst scenario. There will be COVID, there will be everything, and in that scenario, what will be my cash flow for all 3 years? The economist told me that if there is a worst scenario, every year you will be able to earn only 2,000 rupees. My discount rate is 10%, and so my present value of cash inflow is 4974, present value of cash outflow is 8,000, and so my NPV is minus 3026. If there is a worst scenario, if the scenario is average, not worst, not very good, then the economist says that every year your cash flow would be 4,000 rupees. Every year your cash flow will be 4,000 rupees for the period of 3 years. What will be my NPV in that case? If there is average scenario, what will be my NPV in that case? This is NPV. What will be my NPV in that case is a positive 1947. Positive 1947. If average scenario. Again we go to our economist and says, if there is a best scenario, if the sale is booming, if the market is booming like anything, and it is a best scenario, then what will be my NPV? What will be my cash flow? 6,000 rupees every year. What will be my NPV is a 6921 positive. Positive 6921. If there is a best scenario. And this is end of scenario analysis. You are a chartered accountant, you will present to your CEO that if there is a worst scenario, the project is not financially feasible. If there is average scenario, the project is financially feasible. And if there is a best scenario, project is financially feasible, having an NPV of 6921. If there is a best scenario, if average scenario 1947, if worst scenario minus 3026. You will present this data. And CEO will take his own call by incorporating risk into capital budgeting decision. What is a risk? There will be a worst scenario. He will find out the probability, he might do some calculation, incorporate a risk while taking capital budgeting decisions. This is nothing but scenario analysis. Sir, what to learn in scenario analysis is nothing. You need to find out NPV in worst scenario, NPV in average scenario, NPV in best scenario. You are doing nothing but scenario analysis. So, in scenario analysis, we find out NPV in different scenario and we present it to our CEO with this, what is nothing but scenario analysis. The difficult question is over here. Let me answer it. Where the risk is incorporated in scenario analysis, it is found out separately. You can also argue, sir, we are adjusting it in cash flows. Then also the answer is correct. No one will ask you where exactly the risk is incorporated. But understand, in worst scenario, we are reducing the cash flow. In best scenario, we are increasing the cash flow. So you may argue that, sir, we are adjusting risk in cash flow. The answer is yes. You may also argue, sir, we are presenting the data separately, so it is considered separately. But whether in argument 1 or argument 2, you are incorporating risk in your capital budgeting decisions. Most important, most lengthy to calculate, next method, that is sensitivity analysis. Next is sensitivity analysis. Try to understand what is done in sensitivity analysis. Let me again take an Excel sheet and try to explain you. In a project name is a project A. Sales units are there. Sales units are 10,000 units per annum. So you will be able to sell 10,000 units per annum. Your variable cost per unit is 10 rupees. Your variable cost percentage, selling price per unit is 10 rupees. Your variable cost percentage is 40%. What does it mean? Your variable cost is 40% of your sales. Fixed cost is the 10,000 rupees every year. Discount rate is 12%. Discount rate is 12%. And cost of project is 60,000 rupees. Project will run for 3 years. This is an example. I'll go to sensitivity analysis, right? I am writing this in my PPT also. Sales unit are 10,000. Selling price per unit is 10. Variable cost is 40%. Fixed cost is 10,000 per annum. Discount rate is 12%. Cost of project is 60,000. And in this case, I will be directly getting NPV. How I got it? Selling price per unit multiplied sales unit multiplied by selling price per unit is total sales, minus variable cost minus fixed cost will be profit, minus taxes will be EAT, and EAT plus depreciation will be cash flow. This is present value of cash inflow at the rate of 12%. Present value of cash outflow is 60,000. Net present value is 12,055. What is my NPV? Positive 12,055. Try to understand sensitivity analysis. What is original situation is this? What is my NPV is plus 12,055. Try to concentrate. If a sales unit decreases by 10%, if a sales unit decreases by 10%, other all figures remaining same, please understand, if you are doing sensitivity analysis in book without help of Excel sheet, it will be extremely difficult, because then you will have to solve full question again. But in my case, I can directly get NPV. If a sales unit decreases by 10%, what if a sales unit decreases by 10%? What is current sales unit? 10,000. If it decreases by 10%, means it will become 9,000. And because I am having Excel sheet, I will be directly getting answer of NPV, which is 3408. What is NPV? Positive 3408. If a sales unit are 9,000. Tell me what will be selling price per unit in this case? 10 rupees. Variable cost 40%. Fixed cost 10,000. Discount rate 12%. Cost of project 60,000. But my sales units are 9,000, and so my NPV is 3408. My question is, has NPV decreased? Yes. NPV has decreased. By how much? 12,055 minus 3408. So it has decreased by how much? NPV has decreased by how much? 12,055 minus 3408. 8647. From 12,055, it has decreased by 8647 and it became 3408. So it has decreased by how much percentage? It is 8647 upon 12,055, of course multiplied by 100. %71.73%. 71.73%. The NPV will decrease by 71.73% if the sales unit decreases by 10%. If the sales unit decreases by 10%. Let me take another situation. This is number one. Let me take number two. If selling price per unit decreases by 10%, other variables remaining same. What will be selling price per unit new? What is selling price per unit? 10. Now it will become 9. But please understand, here I need to make one more change. Sales unit will remain 10,000. Now we are not considering situation 1. We are considering situation 2. What is situation number 2? If selling price decreases from 10 to 9, other all remaining same. So let me even write down. Here sales units will remain 10,000 and not 9,000, which was in situation number 1. Situation number 2 is independent situation from original situation. And if the selling price per unit becomes 9, this will become 9. Other all things remaining same, my NPV will be 3408. It will be 3408. Positive 3408, and hence this answer will remain same. 71.73%. NPV will decrease by 71.73%. So it is mathematical, right? Whether selling price decreases by 10% or sales unit decreases by 10%, the effect is going to remain same in your sales revenue. Nothing will change in variable cost because it is percentage of sales in rupees, and nothing is changing in fixed cost and anything else. So the answers remain same in first and 2 cases. But understand the third situation. See, whenever I go to third situation, first I make everything original. This is 10,000. This is 10 rupees. So this is our original scenario. In original scenario, now let us go to third situation. If variable cost decreases, what we are taking was scenario, right? Selling price decreases, sales unit decreases, variable cost increases by 10%. Other all things remaining same. My variable cost, what is percentage variable cost? It is 40%. What is cost per unit? 4 rupees. Variable cost from 40% becomes 44. Or from rupees 4, it becomes 4.4 rupees. Other all things remaining same. What will be my change in answer? What will be my NPV? Now variable cost will become 44%. Other everything remaining same. My NPV is 6291. I have directly got answer of NPV, which is 6291. NPV will be positive 6291. How much is a decrease in NPV? Decrease in NPV, you need to compare it with original. Third and second situation is not having any link. Third and directly original situation is having link. So how much there is a decrease in NPV? 12,055 minus 6291. 5764. And what is the percentage decrease in NPV? If variable cost increases by 10%, then percentage NPV will decrease by 5764 divided by original multiplied by 100. 5764 divided by 1255 multiplied by 100 is 47.81. If my variable cost increases by 10%, then my NPV will decrease by 47.8%. I am taking fourth situation. If fixed cost increases by 10%, other all things remaining same, fixed cost instead of 10,000 rupees becomes 11,000 rupees. Other all things remaining same. So let me first make other all things same. This was 0.40 and fixed cost instead of 10,000 will become 11,000. What is NPV? NPV is a 10,640. Positive 10,640. NPV has decreased by 12,055 minus 10,614. 1441. Percentage decrease in NPV. 1441 divided by 12,055. Everything will be compared with original figure, which is 11.95%. If fixed cost increases by 10%, my NPV will decrease by 11.95%. Let me go to fifth situation. If my cost of project increases by 10%, first let me make everything original. Original fixed cost was 10,000. When I make original, I should always concentrate over here that this should come 12,055, and now you can make some changes. If the cost of project instead of 60,000 becomes 66,000, it increases by 10%. Cost of project becomes 66,000. My NPV will become 6055. How much will be decrease in NPV? Decrease in NPV will be rupees 6,000, believe me. Because cost has increased in terms of present value by 6,000 rupees. And what is the percentage decrease in NPV? 6,000 divided by 12,055 multiplied by 100. 50% approximately. If my cost of project is increased by 10%, let me again make everything original. There's a 60,000 and my NPV is the 12,055. Try to concentrate. I can even go for a discount rate. If my discount rate increases by 10%, sixth and last, if discount rate increases by 10%. So what is current discount rate? 12%. It becomes a 13.2%. If everything same, discount rate is a 13.2%. Then my NPV is a 10,595. My decrease in NPV will be 12,055 minus 10,595. $1,460. Percentage decrease in NPV will be is equal to 1,460 divided by 12,055. Which is 12.11%. Please understand all 6 situations. If my sales unit decreases by 10%, I am taking some worst scenario. Then my NPV decreases by 71.73%. If selling price per unit decreases by 10%, then my NPV will decrease by 71.73%. If variable cost increases by 10%, my NPV will decrease by 47.8%. If fixed cost increases by 10%, my NPV will be 11.95% decrease. If cost of project increases by 10%, my NPV will decrease by 50%. And if the discount rate increases by 10%, my NPV decreases by 12.11%. Try to understand, this project is analyzed by bank. Analysis is done by a bank who is planning to give loan to our project A. See, bank will analyze everything as if they are owner of the business. They want this business to be successful so that they get their principal back as well as they earn some interest. So they will be very much interested that, okay, this person has presented me some data. This is the data which I have presented. And I am saying my NPV is 12,055 and hence the project is financially viable. But bank wants to know that if the sales decreases, what will happen? If the variable cost increases, what will happen? Or they want to do some market analysis whether the raw materials are available at this rate or not. Whether fixed cost will happen this or not. Or they want to know this. Which is most sensitive variable? What is, once again, most sensitive variable? Try to understand, I can directly find out. What is variable over here? In 1 and 2, variable is the sales. What is variable over here? Variable cost. What is variable over here? Fixed cost. What is variable over here? Cost of project. And what is variable over here is discount rate. What a person is asking me, which is most sensitive variable? I will directly see this percentage: 12.11, 50, 11.95, 47.8, 71.73. Most sensitive variable is sales. Why? If the sales or selling price decreases by 10%, NPV will decrease by 71.73%. Bank is giving, say, a big amount of loan. Bank will hire an economist who will survey the market that whether 10,000 units can be sold or not by this company. Also, if 10,000 units they are able to sell and they will be able to sell at 10 rupees or not, they will hire an economist to do this survey. If the economist says that it is very difficult to achieve 10,000 target and a genuine target is 8,000, then bank will consider that sales at 8,000 what will be NPV and take a call whether to give a loan or not. But why they are analyzing only sales? Because of our answer that most sensitive variable is sales. Try to understand which is the least sensitive variable is fixed cost. So they will not analyze about fixed cost. They will not analyze whether the fixed cost is there, it will increase or decrease. Even if a fixed cost increases by 10%, there is not much effect on NPV. If a fixed cost increases by 20%, believe me, there also will be not much impact on NPV. So fixed cost is less sensitive and sales is more sensitive. Even this discount rate is less sensitive. So bank will not try to forecast that after 3 years, after 1 year, 2 years, 3 years, the rate of interest in the market is going to increase or not. That is not the concern of the bank because it is a less sensitive variable as far as this analysis is concerned. And cost of project, they should analyze because it is coming in between say 50%. So it is not much less sensitive variable. It is a average sensitive variable, and bank should analyze this. But I hope you are clear with this answer. Which is the most sensitive point? Sales. If the sales decreases by 10%, it is decreasing, NPV is decreasing by 71.73%. What we have done, try to understand. We have done sensitivity analysis of a project A in 10% adverse scenario. Can we do plus 10% favorable? Yes. We can do 10% adverse? Yes. If we are doing 10% favorable, if the sales unit increases by 10%, if the selling price increases by 10%, if variable cost decreases, when we are doing something favorable, that means we should decrease our variable cost. If variable cost decreases by 10%, if fixed cost decreases by 10%, if cost of capital decreases by 10%, if cost of project decreases by 10%, then what will be my answer? I will find out percentage. Believe me, the answers will be nearly same, and you will be getting approximately same answer, that still sales is most sensitive. But I have done right now only 10% adverse. If you go with a big project to a bank will ask for sensitivity analysis plus minus 5% and plus minus 10%. This is normal trend. They might ask even something else, plus minus 20%, they might ask. But this is how the sensitivity analysis is done. All the variables are tested individually. What if it will increase or what it will be decreasing? What will be impact on NPV? Impact on NPV at 10 or 5% changes is nothing but sensitivity analysis. Exactly what we have done, sensitivity analysis of project A in 10% adverse situation. What we have concluded, sales is most sensitive. It is very lengthy in your examination. Why? Even if I have used Excel sheet, still it seems it is lengthy. Here I have found out NPV in Excel sheet. Still it is looking bulky. So if you don't do it in Excel sheet, you will have to find out NPV in all the cases and then find out this percentage and then decide how much sensitive it is. So it is not difficult, it is lengthy. It is easy and lengthy. But sir, it is easy, so it is less important. No. Doing sensitivity analysis, analyzing sensitivity analysis is one of the most important criteria for any business decision maker. Either bank or any other businessman or any other person in the business. This is one of the most important analysis done by the person to measure their risk. Now see, understand, suppose I am not a banker and I am this person who is owner of this business. I will analyze myself. Which portion is most risky? Sales portion is most risky. I need to hire a marketing person who is good so that my 10,000 units of sales is achieved. I need not more concentrate on reducing my fixed cost or going deep into fixed cost. Where I should go into deep is nothing but sales. Easy. If you are not having Excel sheet, lengthy, and very important as far as business decision making is concerned. This is nothing but sensitivity analysis. And last, where it incorporate risk in capital budgeting decisions everywhere, and the answer will be separately. I will be giving different situation of different variables. I will be presenting it and I will be incorporating risk separately. This is understanding of risk analysis in capital budgeting decision. First, what we understood? why risk in capital budgeting decision is important. In one of the decision I told you that it is changing the decision. You should not accept the project. In certainty equivalent we have done this. You should not accept the project if you consider the risk, and you should accept the project if you don't consider the risk. Then we did where we can incorporate risk in capital budgeting decision, and then we did all the methods where the risk is incorporated either in cash flow or in discount rate or separately in different methods of risk analysis in capital budgeting.